The year is 1928. If you're walking down Wall Street, the air feels electric. You see janitors, teachers, and taxi drivers huddled around ticker tape machines, grinning as they watch numbers climb higher and higher. Everyone is getting rich, or so it seems. Before we start, if you want to understand money, investing, in the stock market in the simplest way possible, subscribe to the Stick Market. The 1920s weren't just a decade, they were an era known as the Roaring Twenties. After the grim shadows of World War I, America had exploded into a neon-lit celebration of jazz, flappers, and newfound wealth. The economy wasn't just growing, it was soaring on the wings of new technology like automobiles, radios, and washing machines. For the first time in history, the average person felt that prosperity wasn't just for the elite, it was a birthright. But beneath the champagne toasts, the high society galas, and the jazz bands, the floorboards were rotting. On October 29, 1929, a day now burned into history as Black Tuesday, the floor finally gave way. This is the story of how the greatest economic party in history turned into the most devastating hangover the world has ever seen. To understand why the market crashed, you first have to understand why it went up. In the 1920s, the stock market became a national obsession. It wasn't just a place for professional financiers, it became a cultural phenomenon. People would discuss stock tips at the dinner table, at the barber shop, and in the pews of churches. For the first time, regular people believed they could escape the grind of manual labor by simply playing the market. The magic ingredient that made this accessible to the masses was something called buying on margin. Buying on margin is essentially the 1920s version of a high-interest credit card for stocks. Imagine you want to buy $1,000 worth of stock in a booming radio company. At the time, RCA was the Apple of its day. But you only have $100 in your pocket. In 1929, that wasn't a problem. You would give your broker the $100, and they would lend you the other $900. You now controlled $1,000 in stock with only a 10% down payment. If the stock price went up to $1,200, you could sell it, pay back the $900 loan, and walk away with $300. You tripled your money. It felt like free wealth. It was an intoxicating cycle that drew in millions of people who didn't understand the risks. The entire American economy was essentially a giant house of cards built on a foundation of I owe us. By early 1929, the engine was starting to smoke, but nobody wanted to lift the hood. There were deep, structural problems that the skyrocketing stock prices were hiding. First, there was the issue of overproduction. Factories were pumping out goods faster than people could buy them. In the early part of the decade, everyone bought their first car or their first refrigerator, but eventually the market became saturated. Every house that could afford a car already had one. Demand slowed down, but production lines kept running, leading to massive surpluses and declining profits. While the cities roared, rural America was already drowning. After World War I, European farms recovered and the global demand for American crops plummeted. Farmers were trapped in a cycle of debt, facing falling prices and bank foreclosures long before the rest of the country realized there was a problem. Furthermore, there was a massive, unsustainable wealth gap. The top 1% of the population saw their income rise by a staggering 75%, while the rest of the country saw only a 9% increase. The middle class was running out of actual cash, relying more and more on installment plans, the precursor to modern credit, to keep up appearances. The stock market had become completely decoupled from reality. The prices of stocks no longer represented how much money companies were actually making. They represented pure, unadulterated speculation. People were buying because they expected someone else to pay even more tomorrow. The collapse didn't happen in a single hour or even a single day. It was a terrifying, week-long slide into the abyss that broke the spirit of the nation. The first real tremor hit on Thursday, October 24th, a day known as Black Thursday. Panic selling began as soon as the opening bell rang. The volume of trading was so massive that the ticker tape machines, the devices that printed stock prices on long strips of paper, fell hours behind. Investors were flying blind, selling stocks without even knowing what the current price was. In a desperate, theatrical bid to save the market, a group of powerful bankers, led by representatives from J.P. Morgan and Company, met on the floor of the New York Stock Exchange. They pooled their money and started buying stocks at high prices to show confidence, hoping to stem the tide of panic. It worked, briefly. The market stabilized and the weekend was spent in a tense, prayerful silence, with many hoping the worst was over. But the bankers' Band-Aid was ripped off on Monday morning. On October 28th, the selling returned with a vengeance. People realized the big players weren't going to spend their entire fortunes to save the small investor. The Dow Jones Industrial Average dropped 13% in a single day. Then came Black Tuesday, October 29th. This was the day the bottom finally fell out. The New York Stock Exchange turned into a scene of absolute chaos. Clerks were fainted from exhaustion, brokers were screaming until they lost their voices, and the sound on the floor was described as a continuous roar. 16 million shares were traded in a single day, a record that would stand for nearly 40 years. This is where the margin call became a death sentence for the American dream. When stock prices dropped, brokers called their clients and demanded the difference in cash immediately to cover their loans. But the investors didn't have the cash. Their wealth was all on paper. To pay the brokers, they were forced to sell even more stock, which drove prices even lower. This created a vicious death spiral. Selling caused prices to drop, which triggered more margin calls, which forced more selling. By the end of the day, billions of dollars had simply vanished. People who were millionaires at breakfast were penniless by dinner. You might wonder, if I didn't own stocks, why did the crash ruin my life? The answer lies in the catastrophic banking collapse that followed. In the 1920s, there was very little regulation. Banks had taken their depositors' savings, money meant for rent, medicine, and groceries, and invested it directly in the stock market or lent it to brokers to fund margin buying. When the market crashed, the bank's assets disappeared. When word got out that the banks were insolvent, it triggered the most terrifying phenomenon in finance, the bank run. Imagine walking to your local bank to withdraw your rent money, only to find a line 3 blocks long. People were screaming, banging on the glass, and pleading with tellers. But since banks only keep a small fraction of cash on hand, investing the rest, they quickly ran out of physical bills. They were forced to lock their doors. Between 1929 and 1933, thousands of banks failed, taking with them the life savings of millions of families who had never even touched a stock. There was no insurance. If your bank closed, your money was simply gone forever. This led to a complete freeze in the economy. If people had no savings, they couldn't buy goods. If they couldn't buy goods, factories closed. If factories closed, people lost their jobs. The crash was the primary trigger for the Great Depression, a decade of suffering that redefined the American identity. The statistics are haunting and difficult to wrap the mind around. Unemployment jumped from a mere 3% to a staggering 25%. 1 in 4 Americans had no income whatsoever. In some industrial cities, that number was as high as 50% or 80%. Those lucky enough to keep their jobs saw their pay slashed by nearly half. Families were evicted from their homes, and Hoovervilles, shantytowns made of cardboard, scrap metal, and old crates, sprung up in city parks across the country. They were named mockingly after President Herbert Hoover, whom many blamed for the crisis. The psychological impact was perhaps worse than the physical hunger. A generation that had been raised on the idea of endless progress was suddenly standing in breadlines. Men who had been successful businessmen were seen selling apples on street corners for 5 cents. The sense of national failure was profound, and for a few years, many wondered if the United States would even survive as a democracy. Out of the ashes of 1929, the U.S. government completely rewrote the rules of money. When Franklin D. Roosevelt took office in 1933, he launched the New Deal, a massive series of programs and regulations designed to ensure a crash of this magnitude could never happen again. Several safety nets were created that protect your bank account and your investments to this day. The SEC, or Securities and Exchange Commission, was created to be the policeman of Wall Street. They ensure that companies tell the truth about their finances, and they strictly regulate the type of margin gambling that led to 1929. Perhaps most importantly, the FDIC was established. This program ensures that if your bank goes bust today, the government guarantees your savings up to a certain amount. Because of the FDIC, the bank run is largely a thing of the past in the American mind. We also saw the passage of the Glass-Steagall Act, which originally forced a hard wall between everyday commercial banks and the risky investment banks. While some of these rules have been tweaked over the decades, the core lesson remained. The government has a responsibility to protect the public from the excesses of Wall Street. The 1929 stock market crash wasn't just a bad day at the office for some rich guys in suits. It was a global catastrophe that proved the economy is built on a fragile foundation of trust. When we stop looking at the reality of what things are worth and start chasing get-rich-quick schemes built on debt, the bubble eventually has to pop. The crash taught us that while the market can create incredible wealth, it requires regulation, transparency, and a healthy dose of skepticism. As we look at today's markets, with the rise of crypto, high-frequency trading, and viral meme stocks, the ghosts of 1929 still whisper a warning. Trees don't grow to the sky, and debt always, eventually, demands to be paid. The Great Crash reminds us that the economy isn't just numbers on a screen. It's the roof over our heads and the food on our tables. It is a living, breathing system that requires balance, because when it falls, it takes everyone down with it. If you enjoyed the video and want to understand money, investing, and the stock market in a way that actually makes sense, subscribe to Stick Market. So hit subscribe and click the bell button for more updates. See you in the next episode of Stick Market.